Tuesday, February 24th, and we've got about an hour until the market closes. It is up approximately 2/3%, but I wanted to keep today's show pretty simple with just a couple of takeaways. The first thing, like we talked about yesterday, is market uncertainty. Markets hate uncertainty, and yet I want to point something out. About 6 months ago, that large technology trade really started to falter because the market was saying, okay, this AI, there's too much spending on AI and there's going to be no return on investment. Well, guess what? Just a couple of weeks ago, the market is now saying that AI is going to eat software, kill software, and lead to catastrophic job losses for us. But the market is like, it's such extremes. Which one is it? Is it just not going to lead anywhere, or is it going to be, the end of the world as we know it? That is where it is. I'm choosing somewhere in the middle as usual. And I'm saying that, yes, artificial intelligence is real. It's incredible. We do chats every day on Perplexity or Gemini or ChatGPT, and it's amazing. So it is real. Yes, it is going to take some jobs, and yes, there is going to be overspending on it. So I agree with all of that, but none of that matters right now, because what matters is where we are in the market. And the market right now has a negative sentiment, and the sentiment and the timing need to improve. Okay, so for me, it's a time of caution. And one other note, I just want to point out that you know how I like following the flow of money? Well, guess what? The hedge funds are really significantly increasing their short positions on software. And there's some smart money there. And so I'm really following that, keeping an eye on that. I'll let you know what I find. So the market tide overall has cracked. Momentum has cracked. It just has. So the tide was coming in for a couple of years. We had a great bull run, and the tide was coming in, but right now that momentum has cracked in technology, in software, and it's sort of what I like to think of as like a slack tide. It's not coming in and it's not really, pulling back at this point, but it's somewhere in the middle. And when that happens, there's no choice for me. I have to always, as you know, choose caution. We'll put a pin in that and get back to it. As well, I want to point out again that tomorrow after the close, we've got the earnings from NVDA, also from Salesforce. My read is that NVIDIA has run up into these earnings, okay? A couple of weeks ago, it was down around 170, and now it's up above 190. So it's had a run up already going into the earnings. Plus, I feel like the good news, the expectations are so high for that company that good news and the possible upside is already baked into it. And on the other side, as you know, Salesforce represents the software sentiment right now, which is so negative. And so, given the combination of those two, I have to choose the more cautious approach. And I ask myself, what is the cost? The cost is I miss out on a little bit of a jump or a boost versus a further decline. So given momentum, given sentimentality where it is, I have to pull back and have that dry powder waiting and choose to be in a risk-off position. The last thing I want to say was that yesterday the CEO CEO of JP Morgan, Jamie Dimon, said that he had a couple of worries, and just deciphering it all down, he's worried about two big things. One is that banks are competing too hard for investment dollars and customers. And number two, that asset prices are really high right now. So regarding number one, you and I talked about yesterday, please go back to yesterday's show and look at what we talked about with private credit and the issues with private credit, that money gets locked in there and that you don't have all the disclosure that you do with public companies. And so I share that concern. And number two, I share the concern with high asset prices. Look, we've had this run up in technology stocks, and then with all the spending that they've talked about, that automatically is going to pull down those valuations, because with all this spending, that multiple compression of price to earnings, with earnings dropping, it's going to compress those on this side of the equation, and on the same side of the equation. Recently we've had a run up in things like materials, things like industrials and consumer staples, which is great. Okay, the prices, people have been buying those stocks, so the prices have been going up, but the earnings are not there to support, to go up along with the prices, because those aren't large growth companies, you know, like technology. So you've got prices inflating, but you don't have the earnings going along with it. So those sectors are fully valued and expensive. In my opinion, I agree with Jamie Dimon, and I choose, I look at his concerns, and I agree with them. So again, got to choose caution. That's the takeaway. And I ask myself, last thing, what is the worst that can happen? I miss some profits, okay? Every day, that's the worst that can happen. Every day, I look at lower probability, higher risk trades, and I pass. I pass on 20 different, trades for every one that I do choose. And those lower probability, higher risk trades, I watch them go. Sometimes they go down. When they go up, I celebrate them, because yes, I let them go. But what I chose instead was discipline, investor discipline. And this is it. This is the last takeaway, that when you practice that discipline over time, over thousands of trades, let's say, it's very simple. You are just only trying to make your losses smaller than your gains. That's it. That's the simple equation. Larger gains and smaller losses, and over time, that leads to lower risk and higher returns. So there you go, everyone. And as we always say, it's your money. Protect it, preserve it, then make it. Thanks so much. I'll see you guys tomorrow. Have a great one.